Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to talk about the Bank of Canada's overnight policy rate increase, what it means for you as a homeowner, what it means for you if you have a mortgage, what it means if you're looking to get into the mortgage marketplace, purchase a home, but most importantly, what it means for the Canadian economy. So stay tuned, we're going to dive right in. Once again, I want to take this opportunity to thank all our continued supporters and viewers of the channel, everyone taking the time out of their day to leave a comment, feedback, questions, and private messages through email about all the things that they want to hear or suggestions that they would like to hear about in future episodes. So keep those coming, and we'll do our best to address them in future episodes. Now, moving forward, we want to talk a little bit about financial literacy in the Bank of Canada, as many Canadians are still a little bit confused maybe with what this means for them and their finances. Obviously, the Bank of Canada's increase to its policy rate can impact many Canadians in different ways, especially if you have variable rate mortgages, if you have lines of credits, home equity lines of credits, or anything that might be on an adjustable payment that's based on the Bank of Canada policy rates. So now we're diving into the Bank of Canada. I just want to basically have a quick discussion about what the key takeaways are. So Governor Tiff Macklem came out on the 2nd and with the increase of 0.25% has indicated that the Bank of Canada is looking to move forward and increase rates in the future as we are on the path to rising rates. And that is because they want to address the concerns that we see with inflation. So in the Bank of Canada's toolbox is basically raising interest rates. That is the best way for the government and the Bank of Canada to tackle inflation, is by increasing its interest rates. But what happens when you increase interest rates is generally those changes aren't felt or effective until 6 to 18 months down the road. So that is why we're going to see potentially some increases coming down the pipeline. How often or how many are still yet to be determined. There are a lot of speculation out there, as we've done in a previous video. Some economists are saying 3, some are saying 6. At the end of the day, it's going to be a decision that is made by the Bank of Canada and based on the economy. But I want to just stress that the economy is performing better than anticipated right now. Basically, Canadian economic growth is up 6.7% in the fourth quarter, higher than expected. That's a very good number, as shows that we're exiting out of this pandemic and we're on the right path to moving forward as Canadians. However, there are still some concerns overseas, as we are seeing geopolitical issues with Russia and Ukraine, how that is impacting Europe and if that's trickling over here into North America. But back here at home, we are still having issues with transport, bottlenecks, oil and commodities. Obviously, food is expensive, inflation being the number one concern and the first thing on most people's minds, as it has or is the highest it's been since 1991 at 5.1% as of January 2022. So obviously there's a lot of information to be taken out from the Bank of Canada, but the key takeaways is that inflation is the target of 2%. So Bank of Canada is going to increase interest rates to bring inflation back down to 2%. And we are seeing some issues that are basically on the go or basically being monitored at the current moment, especially when it comes to what's happening in Europe. So now that we understand that the Bank of Canada's goal is to potentially increase interest rates to bring inflation back down, it could take anywhere from 6 to 18 months to happen. What does it mean if you're in a mortgage, or if you have a variable rate mortgage, or anything like a home equity line of credit or a line of credit that's on a variable rate? So if you're on a variable rate product, it's important to understand how that product works, and if your lender is going to effectively, on your mortgage end, change your payments by increasing them by the 0.25%, or if it's going to happen on the back end of the mortgage where their basically amortization will go up or down. So first, for most of the banks right now, prime was at 2.45%. Now with the 0.25% increase to the Bank of Canada rate, we're going to see the prime rate go from 2.45 to 2.70%. Not a major jump, nothing to really panic about now. I mean, as I said, these are healthy moves. This is something that we need to see as the economy rebounds. We need to get it back to pre-pandemic levels. We're going to see this sort of play out. But basically, if you're in a mortgage, depending on the size of your mortgage, depending on what your rate is that you were offered at the time that you got your mortgage, you do have some thinking to do and you have some consideration. Now, as I mentioned, your payments may go up depending on what lender you're working with or the back end of your mortgage. One important thing to understand is if we were to look at, for example, a $500,000 mortgage at the prime of 2.45% minus 80, that would bring you to a rate of 1.65%. And on a $500,000 mortgage, your payment would be $1,760.45. As you can see in the chart, if it goes up 0.25%, your payment goes up $60. If it goes up 0.5%, it goes up to $122.96. And you can see all the way up to 1% what the costs are associated with that mortgage at that rate. Obviously, it's important to understand where you are and where your finances are and if you can absorb that. But what it's important to understand is if you look at what the current fixed rate is for a 5-year at the current moment for 30-year amortization, you're looking at 3.24%. They're hovering in the 3% range, and you'll see that that payment is $2,167.35, making that payment $346.01, which shows the difference in the road that the Bank of Canada would have to take before you get to a certain level. But we're advising our clients right now not to really panic and not to go in and lock into a fixed rate mortgage, depending on their scenario, and having a discussion with them about where they plan to be in the near future. If they're approaching a time where they're looking to sell, refinance, remodel, pull out some money to do some renovations or plan a trip. There's many different scenarios in which you may not want to lock into a fixed mortgage because you may plan on selling, and depending on your income, it can impact everybody differently, right? So one thing that we were talking with some clients about, as I said, because everyone is qualified under the stress test rule of 5.25%, some clients that we had a few years ago, they were qualified at 4.79%, which is a little bit lower, but most Canadians were stress tested at a higher rate, which means they are able to absorb the difference up to a higher amount in their payments. Although we may not like to absorb those payments, the key is that you were already priced in to accept or to at least go up to the range of those payments on your qualifying rate. And every single Canadian, if you're mortgaging, getting a new mortgage or refinancing your house right now, you are undergoing that stress test. The only time you do not go under that stress test is if you are renewing your existing mortgage and not touching it. So with all this discussion with the Bank of Canada, how the rates are changing, as you can see, minor changes to the Bank of Canada rate will not impact the real estate market, in my opinion, too drastically. I think even a couple of rate increases may not change the dynamics of the real estate market as of yet. Now, one thing to understand is as of March right now, we're starting to see, or I'm starting to see with our clients here in the local Vaughan area, that things are starting to change a little bit as more inventory is popping up in the market. Generally, January and February of the beginning of the year are usually slower months with inventory. Obviously, we've seen an extremely low inventory over the last few months, but generally they are lower. And as the spring starts to set forward, we're starting to see some more inventory hit the market. And we're starting to see some clients, yes, they're going into multiple offers, but I think that mindset is slowly changing a little bit. Don't quote me on it. As I said, this is what we're seeing locally, and we're seeing a few more clients that are able to actually put in offers as the mindset begins to change. Now, that's not all cases, but what I'm trying to say is that basically first-time home buyers that were sitting on the sidelines that weren't looking to compete in multiple offers, I think there might be a light at the end of the tunnel for many young Canadians. Obviously, prices are still high. I don't see the prices coming down, particularly in the next few months. As I said, I'm only looking at 3 to 6 months. That's basically the best observation I can give. Anything outside of that, you're just gambling or making a prediction, and you know how much I hate making predictions. So just wanted to leave that information out there saying, we're seeing some change in the real estate market. Listings are starting to come up a little bit more. Some changes in regards to the interest rate. Don't think they're going to actually be a major player in pushing real estate buyers or buyers out of the market. It all depends on exactly what their budgets are. The one thing I do see changing is maybe someone that was looking at for example, semi at a certain price may convert that into a town because they don't want to spend the extra money, and based on the difference in the payments that we saw, maybe they're going to readjust to leave some buffer in there for future absorption of interest rate hikes. So I hope you found this video helpful. If you did, feel free to give us a like, share, and obviously we want to thank everyone for their time in watching this video, as well as wish everyone a great Friday, happy Friday, and an even better weekend ahead. Until next time, thanks for tuning in, and we'll see you next week.